BOB Bank of India.
Good evening, ladies and gentlemen. I am Pawan Kumar, General Manager, Performance Planning and Review Department of the bank. On behalf of State Bank of India, I am delighted to welcome the analysts, investors, colleagues, and everyone present here today on the occasion of the declaration of the financial year 26 results of the bank. I also extend a very warm welcome to all the people who are assessing the event through our live webcast. We have with us on the stage our Chairman Sir, Shri C.S. Setty, our Managing Director, Corporate Banking and Subsidiaries, Shri Ashwini Kumar Tiwari, our Managing Director, International Banking, Global Markets and Technology, Shri Rana Ashutosh Kumar Singh, our Managing Director, Retail Business and Operations, Shri Ram Mohan Rao Amara, our Managing Director, Risk Compliance and SARG, Shri Ravi Ranjan, our Deputy Managing Director, Finance, Shri Anand Sundar Paul, our Deputy Managing Directors heading various verticals and Managing Directors of our subsidiaries are seated in the front rows of this hall. We are also joined by Chief General Managers of different verticals, business groups, Chief General Managers and other senior officials of the circles, and various officers are connected through our live webcast. To carry forward the proceedings, I request our Chairman Sir to give a summary of the bank's financial year 26 performance and the strategic initiatives undertaken. We shall thereafter straight away go to questions and answer session. However, before I request Chairman Sir, I would like to read out the safe harbor statement. Certain statements in today's presentation may be forward-looking statements. These statements are based on management's current expectations and are subject to uncertainty and changes in circumstances. Actual outcomes may differ materially from those included in these statements due to a variety of factors. Thank you. Now I would request Chairman Sir for his opening remarks. Chairman Sir, please.
Good evening, ladies and gentlemen. Thank you for joining us for today's analyst meet following our Q4 and FY26 results. At the outset, I would like to state that our FY26 performance reflects a consistency born out of a calibrated multi-year shift in how we run the bank. We have focused on strengthening our core fundamentals of asset quality, capital, operating efficiency, and franchise depth. The result is a balance sheet that is performing, robust, and resilient. Let me briefly touch upon the environment we are operating in. The global economy remains in a phase of elevated uncertainty, with growth projected by the IMF at 3.1% in 26 and 3.2% in 27. India, however, continues to outperform, with the FY27 growth projected at 6.9% by the RBI, supported by domestic demand and macro stability. That said, geopolitical developments and climate-related disruptions remain key risks. Inflation is expected at 3.8% in the near term, with a full-year estimate of 4.6%, with some upward bias on account of energy price movements and weather-related uncertainties. From a banking system perspective, credit growth for scheduled commercial banks accelerated to 16% in financial year 26, while deposits grew at 13.6%. The momentum is continuing in the current financial year, and we expect credit growth at 13 to 14% and deposits at 11 to 12% for FY27 for the system. Asset quality continues to remain strong and capital buffers comfortable. However, beyond these metrics, the operating landscape is being reshaped by deeper structural shifts. Technology risk is now becoming a systemic risk. The emergence of advanced AI models capable of identifying and exploiting vulnerabilities at scale has fundamentally changed the cybersecurity paradigm. The industry is therefore moving towards coordinated, system-wide resilience frameworks in partnership with the regulators, the government, and other key stakeholders. At the same time, the regulatory approach to risk is becoming more forward-looking. The transition to expected credit loss-based provisioning from April 2027 is a significant step in that direction, and we are confident of a smooth transition. In this environment, our approach is focused not merely on growth, but on improving the quality of our growth by making it more durable, capital efficient, and more resilient across cycles. This is being executed through a set of aligned actions. We are simplifying the bank at scale through Project Saral, which I mentioned earlier with you, our operations process reengineering initiative. The larger objective is to simplify the customer journey and release capacity within the system to focus more on relationship building and business growth. Second, we are building a more digital native, intelligence-led organization. Through Analytics 2.0, data and AI are becoming central to decision making across credit, risk, and customer engagement. Third, we are strengthening our liability franchise. As savings increasingly shift towards market-linked instruments, we are deepening customer engagement through YONO, expanding ecosystem partnerships, and creating relevant offerings for diverse segments. Our balance sheet strategy is moving from volume-led expansion to a value-accretive growth with a sharper focus on granularity, product competitiveness, and risk-adjusted returns. We are also expanding into new growth areas, including startups, alternative investments, ecosystems, and global trade to keep our portfolio diversified and future-ready. Against this backdrop, let me now highlight the bank's Q4 FY26 performance. Driven by strong operating profitability and improved asset quality, I am glad to share that the bank has surpassed key milestones this financial year. Net profit reached a record high at 80,032 crores, up 12.88% year-on-year, supported by 11.25% year-on-year growth in operating profit, with a domestic NIM at 3.03%, supporting our guidance to maintain NIM above 3%. As total business crosses the 109 trillion mark, this performance showcases our strengthening market position and sustained customer trust. Our domestic business has grown by more than 11 trillion rupees on year-on-year basis. Our balance sheet size has crossed 76 trillion rupees. We achieved resilient deposit growth of 11.03% year-on-year by about 6 trillion rupees, driven by strong inflows in retail term deposits, which grew by 14.77%, and a double-digit savings account growth at 10.6%. Despite competitive environment, a 39.46% CASA ratio, which is an improvement of 33 basis point quarter-on-quarter, sustains our low-cost funding advantage, reinforced by 12.7% growth in foreign deposits. The credit growth has been robust and was up 16.87% year-on-year as in March 26, which was driven by all the segments registering double-digit growth. The domestic credit deposit ratio was 73.08% at the end of FY26, an improvement of 337 basis points year-on-year. All the components of RAM have witnessed sound growth. The corporate credit growth momentum continues and grew by 14.83%. Our foreign offices have continued to perform well with growth in advances at 20% year-on-year. In dollar terms, it is 8%. The asset quality continues to be industry leading with gross NPAs at 1.49%, improving by 33 basis points, and net NPA at 0.39%, further improving by 8 basis points on year-on-year basis. The PCR was at 74.36%. The sustained two-decadal low in NPAs validate our rigorous underwriting capability, disciplined credit practices, and effective credit risk management. Strengthening our capital position, our CAR has improved by 115 basis points year-on-year and stands at 15.4%, which is well above the regulatory requirements. The bank has enough headroom to address future credit growth requirements. Further, our subsidiaries are demonstrating consistent performance and are driving stakeholder value through digital expansion, product innovation, and improved customer experience. We will continue to nurture these subsidiaries and see them creating value for their own shareholders as well as the shareholders of SBI. At SBI, digital transformation remains a continuous journey where YONO is central to our strategy. The strong adoption of our new YONO, crossing 4 crore registration within 3 months of launch and bringing total users about 10 crores confirms that digital-first banking is now deeply embedded in customer behavior. 66% of new savings accounts originating on YONO platform in FY26 demonstrates our successful transition to a digital-first institution. Our FY26 performance reflects both a strong foundation and the strategic repositioning. In an environment of intensifying liability competition, evolving customer expectations, and rapid technological change, we are reshaping our balance sheet, strengthening liabilities, embedding AI and analytics into our operating model, and diversifying funding sources and growth ecosystems. Our focus remains firmly on delivering consistent, risk-adjusted returns supported by disciplined underwriting, strong asset quality, and robust internal capital generation. Our emphasis has always been on efficiency and return metrics, with our ROA consistently greater than 1% and ROE at 18.5% at the end of Q4 FY26. Our ability to maintain an ROA greater than 1% at scale puts us in a top league of global financial institutions with an advances book of more than 49 trillion rupees, investments about 18 trillion rupees, deposits of more than 59 trillion, and a balance sheet size of nearly 76 trillion. Most importantly, we are empowering our people with continuous training and inclusive culture to build a motivated, future-ready workforce in this dynamic environment. To conclude, we see SBI's journey as a closely aligned with India's long-term economic transformation. As the country progresses towards the vision of Viksit Bharat 2047, we believe SBI has a unique role to play as a key enabler. Thank you once again for your continued engagement and support. My team and I will now be happy to take your questions.
Thank you, Chairman, sir. We now invite questions from the audience. For the benefit of all, we request you to kindly mention your name and company before asking the questions. To accommodate all the questions, we request you to restrict your questions to maximum 2 at a time. Also, kindly restrict your questions to the financial results only and no questions be asked about specific accounts, please. In case you have additional questions, the same can be asked at the end. We now proceed with the question and answer session, please. Thank you.
Yes, sir. Definitely compliments to you, sir, for such a robust business growth, very good asset quality. And if you see on year, the highest operating profit and the net profit going beyond 80,000 crores. There is only a few concerns looking at the result on the face of it of this quarter, where our operating profit also has gone down and the net profit also has gone down as compared to the last quarter. And mainly the profitability dragged by the treasury operation, the loss in the trading, maybe a trading loss or a loss on the valuations of the treasury book, I think, which is about 3,500 crore, and little bit increase in the overhead expenses in this quarter, which may be because of the last quarter, it has gone up by about 1,500, 1,700 crore, the overheads. So, having said that, our slippage has also gone up little bit in this quarter, maybe 1,000, 1,200 crores up in this quarter. So, in this scenario, now with the treasury outlook looking little better in the coming quarters, and overhead maybe one time because of the last quarter of the financial year, can we have some idea of going forward, where do we stand on the profitability front? While the loan book is growing very well, but you yourself said that we can look at still about 14 to 16% growth in the credit book. So, looking at this scenario, now coming forward, can we have the comfort of having, if not good income from treasury, at least the losses are not there, so that the overall profitability increases? And coupled with that, now with the ECL guidelines getting finalized, how are we prepared with that? Is there impact is going to be taken up in the coming quarters? Whether the numbers have been drawn, and what is our plans to take care of those provisions? Vis-a-vis now, as far as the business growth is concerned, with the emergency line of credit guarantee scheme 5 coming up with 2,50,000 crore, 5,000 is for airlines separately. So even business growth, you yourself have said in some of the interviews that 70,000-80,000 crores of prospects are there only through this line of credit, looking at your customer base. So in all, can you just give your views on the few points which I have raised, sir, in this case?
Ajmera Saab, you said few points, is it? Okay. But very comprehensive assessment what you've done. First of all, I think a few questions which are in your mind, let me first answer them in terms of, there seems to be some amount of, maybe we were not communicated enough in our Q3. I believe, I've gone through my transcript again in Q3 analyst call. We made it very clear that our exit NIM is going to be 3%. And we also mentioned that in the Q3, December 15 repo rate cut will be having full impact in the Q4. And these things are something what we stated upfront. What has not been known to all of us is the yield movement, which had definitely impacted the treasury income. But even then, what we realized that despite the sharp movement in the bond yields, because of our very low exposure to fair value portfolio, our hit has not been very significant. But you are comparing with the Q4 of the previous year, for instance, we have had 3,800 crores one-time gain on these security receipts. Apart from that, we had positive treasury gains in that quarter. I think overall, we all believe that we have given a good set of numbers for Q4 as well as full year. And we stuck to our guidance in terms of 1% ROA and 3% exit NIM. I don't think there was any surprise to us, but I think there is some assessment in terms of what analysts like you have done on the NII part. There are two reasons why the net interest income has got impacted. As I mentioned, one is the impact of 25 basis point rate cut, which is reflected in the EBLR portfolio, and 5 basis point cut which we have done in the MCLR is fully factored in the Q4. And EBLR book also has gone up. In fact, the composition of the floating rate loans slightly has increased. That also is a combination of factors which we had known, and that is the reason we always gave a guidance that when we talk about NIM, we are not talking about on the quarterly NIM numbers. It is the full year exit NIM which we have given the guidance, and I hope that we broadly fulfill that. I think this is something what I wanted to clarify. And as for the treasury going forward, I think 3-4 questions which you asked, let me answer in the seriatim. One is slippages. Slippages of Q4 slippages is not a matter of concern, and we have from these slippages we pulled back almost 850 crores as we speak. That means there is no structural issue in terms of asset quality. Let me assure you on that.
West Asian problem.
So there is no impact of West Asia so far. And this slippages has nothing to do with any stress in the system. It is seasonal. Most of the slippages have come from agriculture and some from SME. I will give further guidance as we speak in terms of slippages, but we are sticking to our credit cost guidance of 50 basis points. Even despite whatever happens on the West Asian conflict, we are confident that asset quality is holding up. Unless, of course, there is something dramatically happens in the system and macros will further get disturbed. As things stand now, we are sticking to our credit cost guidance of 50 basis points, our credit growth guidance of 13 to 15%. And you mentioned about treasury income, and we believe that the yields will will not create much pain going forward. Even if assuming that the yield movement will be there, our internal guidance, which has gone wrong earlier, we felt that the bond yields probably would be moving up to 6.75. There has been a sharp movement, but now also our treasury holds a view that it would be in the range of 6.75 to 6.9, not beyond that, unless the West Asian conflict or any other fiscal imbalances create a problem. ECL guidelines, before ECL guidelines, let me also talk about ECLGS, which is a proactive and preemptive measure in my view. A lot of people ask me, are there any customers who are coming and asking for ECLGS? Not yet. It will take about 8 to 10 days for us to operationalize these guidelines. And we are reaching out to customers in case of any need, they have this facility available. My assessment of 70,000 to 80,000 crores is the full limit which is available to MSMEs and other non-MSME customers. But our assessment also indicates that not more than 30, in the worst case 30-40% people will be utilizing it. It could be more as the conflict goes further, but it is an excellent step from the Government of India side to make this available in a proactive measure. ECL guidelines, we have made the models ready based on the draft guidelines. We are further tweaking the models based on the final guidelines. It would not be appropriate for me to give a number at this juncture. I think probably after the end of June quarter, we will have much clarity in terms of what is the stock which will create, which is required to be taken care of.
But approximately, you have about 29,000, 30,000 crore buffer already.
Admin Sahab, I don't want to hazard a guess at this juncture. Let us stick to that. We are not going to give any number at this time. But one thing I want to make it very clear, as I made earlier also, that this transition is going to be smooth. It is not going to impact our ability to fund credit growth. It will not be impacting our capital ratios as much. And I hope we will be smoothly transitioning in the next 4 years in terms of the ECL guidelines implementation. I hope I answered all your questions.
Yes, sir. Yes, okay. Sure. Thank you, sir.
Hello, sir. Good
Maru.
evening. Hi. So, I had a couple of questions. Firstly, just one clarification in NII. We do not have any impact whatsoever of any forex translation or any forex loss, because I remember years ago in a COVID quarter we had some NII issues relating to forex as well. So just wanted to clarify
no,
that.
it's a core NII, except that the usual interest and tax refund which has come around 1,000 crores, which is added in NII, but it is partially offset because some of the penal interest which used to be booked in part of interest has moved to penal charges. But that is just about 600 crores. It is purely the impact of EBLR and some of the floating rate loans on the corporate side.
Okay. So basically the interest on tax refund is 10 billion versus around 7 billion last quarter.
I think it was 800 crores.
Yeah, 7.7,
yeah.
sorry.
Correct.
Yeah, 760. Okay. And then, sir, just in terms of margins, right? So what is your outlook on margins near term and longer term as well? Because this quarter we did see that NIMs, global NIM in the quarter declined around 18 bps. So what is the outlook going ahead? Maybe first half and then, longer term also.
But I would like to give guidance for the full year, Maru. Okay. And as I promised, I said that I'll give first quarter itself the full year guidance. And we do not want to create confusion in terms of quarterly guidances.
Got it.
Because the quarterly, in a large book like ours, there is a seasonality, there is a, momentum of credit growth. It's very difficult to give a guidance on the quarterly basis. We are still giving a guidance on an annual basis. We are sticking to our NIM of more than 3%.
For
the
FY27.
full year. For the full year.
Okay, sir. And if you could give the breakup of gross slippage for Q4 26 and Q3 26. So that's one question. And the other question I had is that what is your total Middle East portfolio? And what is the India-linked Middle East portfolio? Like some Indians working abroad may have taken home loans, etc. Here. So both, if you could give some sense of that.
So I'll answer the second question first. I think that answers many people's minds, what is happening on the Middle East. See, the Middle East, we have two large offices, Bahrain and DIFC, Dubai. But the other operations are very small, Bahrain retail operations, and Dubai we don't have any retail operations at all. So primarily it is a wholesale book. And out of this, it is predominantly either a bank exposure or a sovereign exposure. And in both these cases, we do not see any concern on that. And we don't have any much direct exposure either to the medium enterprises or even corporates. So I don't see the great impact coming from the corporate side, wholesale book side. On the retail side, where the people working in the GCC taking the housing loans, it is predominantly in Kerala. The rest of the country is not concentrated. But we have not seen any impact on the asset quality, particularly on the housing loans. They normally take housing loan. And a lot of people, what we have realized that they have not come to Kerala Bank. They're still staying put in the place where they're working. And there is no asset quality concern at this juncture. And because most of the GCC countries are coming to a normalcy, we had moved our people from the GCC countries to India to work from Mumbai, but all of them have gone back now, barring a few, one or two. So which means that the things are stabilized. It will take some time, but I don't think it will lead to any concerns on the asset quality. The first question on the...
Yeah, I wanted the slippage breakdown, gross
gross slippages anyway we don't ever give. It's always first quarter which gives gross slippages and subsequently it is all net slippages. But there's absolutely no any predominant movement of any concern in the slippages.
And so what will be that India-linked proportion of portfolio, the Kerala home loans?
Very small. Very
okay.
small.
Okay, thank you, sir. Thanks a lot.
You want to add anything, Ashutosh, on the...
No, sir. So what you said is right, sir. So absolutely no concern as of now for us. The branches we have in Dubai and Bahrain, like Chairman said, is wholesale banking business mostly we do. And Tel Aviv is mostly non-fund-based business guarantees we issue for Indian, essentially the defense kind of. So the corporate book what we have is 98% plus is either sovereign or banks or sovereign related exposures. So we are not concerned about any corporate exposure in the Middle East for these three branches. Globally also exposure we have with the India's link, total exposure will be 10-12 billion, including trade finance and all, but we are not seeing any concern on that side.
Sir, hi. Jay Mundra from ICICI Securities. Sir, on your this FY27 3% plus NIM guidance, that is domestic or the global one, just to clarify.
So our guidance is generally domestic. We are not giving wholesale, full bank NIM ever. Because see, the overseas book is a different creature altogether. So you're talking about domestic NIMs.
And sir, within this, so let's say there are two parts. One is yield and one is cost of funding or cost of deposit. If I calculate this quarter, right, so yield on interest on advances, they have been flat, right, 0.4% increase, whereas advances have grown by 5% QOQ. In last quarter also they were 5%. So average basis also they should be around 5%. So what explains the decline? If I calculate this way, the yield on advances, they've declined by around 30 basis point. One is of course the repo rate movement. But apart from that, is there anything else which could linger? Because hopefully the repo rate movement ends here, right?
Correct.
So what is your thought process on yield on advances going ahead? Would they be similar, stable, and hence, yeah.
Yield on advances probably would have some uptick. What happened in the Q4, apart from the EBLR movement, see your EBLR plus floating rate loans in other than MCLR in corporate book was 43% previous year. It's moved to 49%. That movement also actually creates. So assuming that our house view is that the repo rate cut is unlikely this year. Repo rate movement is going to be stable, which means that whatever we see on the spreads will remain. And on the corporate side, we are seeing how we can change the asset mix and reduce the floating link to T-bill essentially, and bring back the yields to normalcy. And much of the loans we have already started moving to MCLR in the corporate side. All loans which are getting repriced or refinanced or renewed today are predominantly moving to the MCLR and reduce the floating T-bill rate linked loans. That gives us confidence. One is the repo rate being stable. That is no movement on the EBLR side. And the corporate book, which moved significantly towards T-bill, probably will be brought back to MCLR. Even without considering them also, we are confident that we will be achieving the 3% NIM. Because of the, the stability of whatever currently achieved.
And MCLR will not reprice downward, right? Because
it will not be repriced because we are not adjusting the interest rates on the deposits. Either repriced lower or repriced higher is unlikely.
So, sir, assuming there is no change in the in the card rate of the deposits, the cost of deposits should still decline, right? In at least in the near term.
So there are two reasons why they will decline. One is, I think we are focusing more on the CASA. CASA component will contribute to the reduction. If you see, even in Q4 also, we have contained the cost of resources. And the other thing is that we have cut down significantly on our wholesale deposits, which are expensive. We will further be cutting down on the wholesale deposits, which gives us some relief on the cost of resources.
Right. And secondly, sir, on LCR, if you can highlight what was the LCR during the quarter, Q4, and after these guidelines which have come in from April 1st, how does that changes?
What is the LCR number you have?
Sir, for the quarter it was 124 point something, 124 approximately.
That was average for the
That
quarter.
was the average for the quarter.
Because last quarter it was, I think, 130.
130, yeah.
Yeah. That the liquidity is being consumed, right? You are growing at 17%. Right. But the current guidelines will give us around 3 to 4% improvement in the LCR.
And what would, this, let's say 124 becomes 127, 128. What would be your, let's say, floor and maybe the upper limit for LCR to operate in? See, for a bank of our size, we would like to have at least 10 to 15% over the regulatory minimum. Regulatory minimum is 100%. So 115%, I think, is a good ratio to have. Today we have, as we entered the year, around 125%. And in this quarter, again, it will move up further. So, but we would definitely need, if the credit growth continues, some moderation will happen in the LCR. We would be comfortable around 115 to 120%. Sure. And lastly, sir, if you have the number for AFS reserves, what was the movement in this quarter? What was in Q3, December end, and what is it at the March end? You have the number? We will give you that number separately. Thank you, sir. Thank you so much.
Hi, sir. Pritesh here from DAM Capital. Just a few questions here.
Yes.
So one is on the loan processing fees. It has been quite strong this quarter. Almost doubled, I think. What has been the reason for that? Because loan growth has been strong throughout the year, but suddenly this quarter we saw that growth.
What's your name, you said?
Pritesh from DAM Capital.
Pritesh, thank you very much for asking this question. I was just waiting for someone to ask this. Everybody is worried about NII. See, I think, rightfully, I'm not undermining that. The overall construct which we mentioned right in the beginning, I don't know, it sounded more English to you, but we really mean every word what we mentioned there. We are focusing on the relationship value. For instance, this processing fee is not only coming from retail operations. Retail operations, of course, have given a significant uptick in the processing fee. We have seen both in the large corporate, small corporate, MSMEs, everywhere we have readjusted our processing fee. It is not only readjusting the processing fee, not by way of increasing, but reducing the concessions. We have promised them the good quality service, and we started charging for that processing, the process efficiency. And today we have almost in the retail operations, we have had a growth of 50% in processing fee, and the corporate book almost 30-35%. So I think we are encouraging our field staff to be more proactive in terms of negotiating on that.
Sure. Second question was on basically the GSEC yields have moved up, but our investment yields are slightly lower. One would have expected that the yields for us also would have tandemly moved up in the quarter. Is that that we have moved some of the securities and booked some gains, and that's why the losses are slightly lower, or any other strategy?
Some trading has been done. If you see, our trading profits have been good this quarter also. So that means that some of the switches we have participated in that, which also had portfolio yield moderation has happened there.
So basically, the profitable securities have been sold, and that's why.
I mean, it depends on what securities are asked by the RBI, right? Shamshar, anything you want to add?
Yes, sir. Of course, we did sell some amount in profit of one more and switches. That the amount is usual what we do within 5% allowed. Over and above, it is 5% allowed. So if you want, we can give the figures. We made in the entire year around 6,321.
Sure. So last question was on this. Basically, there were news articles that a lot of RBI has asked oil companies to move their dollar buying and selling through our bank, and also related FX related transactions to our bank. How is that going to benefit us? Any outlook on that?
I'm not aware of this.
Oh, okay. Thanks.
Yeah, hi.
Excellent annual numbers and record numbers and excellent, very high payment of income tax, over 25,000 crores. You are doing great service for the nation.
Is a backhand compliment, is it?
It's a challenging year, and despite that, over 25,000 crores in this type of environment is really wonderful. And a couple of important points. Now everybody is looking at value unlocking, and we have over 10% in National Stock Exchange. SEBI chairman has said it should get listed soon. So what's the thought process on value unlocking? I see page number 55, which talks about total reserve and surplus 5,95,000 crores. Now we'll get valuation, fair market valuation on the balance sheet. Apparently this number will also go up. But in terms of business generation IRR, would like to know what is the thought process if we can use some of the capital or value generated in the core banking business, and short term or long term, ideally. So that would be very nice if you can share in detail. Second point is on market share of SBI. Today we are talking about 22.5%. There has been some thought process and talks going on if one can increase market share gradually. So what is the thought process of the bank's board of increasing market share, whether through rural banking or through district banking or branches, and aligning with the government's objective, if in how many years we can come to 25% market share, and what is our core strategy on that, also including globalization. I think it could be a great opportunity. That's it. I found the results better than expected because I've been present and looking at the transcript, saw it as a knee-jerk reaction, but with your clarification and lot of value unlocking, hopefully your direction towards that should help in creating greater value year to year. All the best to the board and the team.
Thank you. Thank you.
My name is Manoj Alimchandani.
Yeah, of course, I know you. But I wish I own 10% of NSE. Unfortunately, we don't. Within the group, we have around 7.3% holding. But bank itself would be keen on participating in the OFS. We have given our in-principle consent to them. What kind of participation will happen, the board will determine. But as you mentioned, I think the moment NSE gets listed, the whole shareholding by SBI will be available as reserve to us to mark to market. Currently, it is not mark to market in our books. Yes, I think several times you yourself have mentioned the hidden reserves what SBI has in terms of strategic investments. And this year, I think if NSE gets listed, that unlocking will happen. We are also seriously, as you are aware, we have embarked on listing SBI AMC, and hopefully in this financial year we'll be able to complete, which will result in capital augmentation, CET1. And this capital we would like, that's what I think it gives us confidence that going forward, two things which are required for supporting the credit growth in terms of capital is fully, we are convinced that we have the capability. Even with the current position, we can fund almost 12 trillion credit growth. And the further augmentation will help us going forward. And enough liquidity in the system. And a large bank which has got 59 lakh crores, which will be probably in this month will be crossing 60 lakh crore deposits, growing at 11 to 12%. As I mentioned in my inaugural speech, it's a bank which is adding 11 lakh crore business every year, which is equivalent to several other banks. But we want to do it efficiently. The scale is a kind of given, right? When you have 109 lakh crore business, the normal growth rate itself will add to your scale. So we want to use this capital efficiently where it is required, and efficiently in terms of giving the return to the investors, shareholders, so we are sticking to our guidance through the cycles. We would like to ensure 15% return on equity to our investors minimum. So your second question, I think is a very, very important question, that when you have such scale and such dominant market share, how do you grow further? And this is something what we deliberate very seriously in the board. And we have now embarked, I think I must have mentioned last quarter also, that we want to increase the market share in every district. Today, fortunately, the data is available, market share data is available at the district level. So it is our strategy is that even if in a district you have a dominant market share of 60%, there are districts where SBI has a market share of 60%. But our guidance is that 1% increase in market share, whichever is that, whether you have 10% market share or 60% market share. Every district we would like to grow 1%. I'm very glad whenever I travel in the field, the lowest officer in the bank also is aware of market share. So we are trying to improve the market share in our district. I think this is a great strategic shift which is happening. And 25% is a little farther, but we would like to move 1% every year. That means, 4 to 5 years. As I mentioned several times, we would like to be 25% in terms of the GDP of the country.
Thanks for elaborate answer. If you can permit me, particularly on segments, I found gold loans. It was a focus area. Now we have, besides 100% growth, we have a good critical mass of over 1 lakh crores as a thing. Express credit also now initiative since a few years. We have a good base now. Auto sector, we found a little growth, a little muted at 8.5%. But hopefully with this peacemaking efforts, mediation prices coming down, oil prices, hopefully you can tell us the growth can improve. So can we look at also gold loans, whether we can, why don't we use opportunity to increase our NIMs through that? Because other gold loan players, NBFCs are really having usurious rates, and we seem to be doing a service. But with the entry made, if we can increase market share and increase NIMs, and also your thoughts on this increasing the growth in advances further through this verticals which we mentioned and your priority areas. That will be nice.
You want to respond before I respond?
So AFS reserve somebody has asked. So this 31st March number is 5,136 crores. AFS reserve.
They want to see the movement.
Movement in December quarter is 8,151. So roughly 3,000 crore decline in
AFS consumed. Reserve has gone down.
Yeah.
But it did not have much impact on the CET1 ratio. Your question in terms of the gold loans, so the gold loan market is highly diversified. The ticket size, what we look, for example, average ticket size of gold loan in our books is about 2.5 lakhs. These are price sensitive segment. They're not 20,000, 30,000 loan amount of people who are willing to pay anything, any rate of interest. These are price sensitive. And gold loan also, you must realize there is a very efficient equity product, return on equity product, ROE product, because there is zero risk weight on that. So we would like to have a very strong growth, but with very qualitative growth. For instance, our overall LTV is 52%. That means, you have very safe lending there. And yield is also not bad. I think 8.5 to 8.75 is something what we get on this. 9%. 9% is a good yield for a product which doesn't require any capital allocation at all. And with almost zero NPA.
Yeah.
Thank you.
Thanks.
Hi, sir. This is Piran, engineer from CLSA. Just firstly, sorry to harp on the NIM question again, but we exited with NIMs of 2.9%. Our roadmap to 3% NIM would be driven by deposits?
No, we exited 3% domestic NIM, and our guidance always has been on the domestic NIM.
But so, okay, 3 was the full year NIM, right?
Yes, full year NIM.
The last quarter's NIM was 2.93.
No, it is even lower.
It's in your PPT, 2.93.
Yeah, 2.93. Domestic NIM is 2.93.
Yeah, so for that to improve, is it going to be a yield-driven thing or a cost of deposits-driven thing?
So, as I mentioned, you have 60% of fixed deposits. And fixed deposit growth is significant for us, 14%, 15% on the retail term deposit. We would like to have both levers used. One is reduce further cost of resources. It may not be very significant, but reduction of cost of resources will happen in two ways. One is whether we can further augment our CASA in terms of absolute amount. And number two, reduce the wholesale deposits, which are expensive. But that moment will be very limited. I don't think there will be any significant pickup on that. You're right. I think it will more in terms of the yield and advances management. We would be looking at asset mix and also increasing spreads wherever it is feasible, both on the corporate side as well as retail side.
Okay, thank you, sir. Just secondly, what percentage of our MCLR book is yet to reprice?
MCLR book, I think the 5 basis point which is done in December is reduced, right? That will take about 3 to 4 months, but that is not much great impact.
But the ones done in October, a lot of them would still be left, right? Because if
6
it's 1
months
year,
MCLR is predominant, so we have about 40% which is 1 year MCLR. Okay. Some part of that probably is left out, otherwise mostly is priced.
Understood. And sir, lastly, just on current account deposit growth, we were doing pretty well, growing 20-25% until 2-3 quarters back. Now it's come down to single digits. Anything to read into it, or is it just a period end number?
No, period end number of the previous year which has impacted. See, we had a period end movement in FY25, March 25. We had a significant current account movement because of the government funds release. Those things were not there. And it was a very large amount, almost 50,000 crores, which has come in the last few days of March 25. Despite that funds not being available, I think we have done phenomenally well in the current account. And as I mentioning somewhere earlier, we have had 21% decline in the government current account deposits in the last year. Whereas we completely pivoted towards non-governmental current account, where we had 23% growth rate in the current account. That is the number which you see, the year-end number for March 26, in my view is the best number ever could achieve by SBI. Because we had a double impact of, the last minute flows which were not available this year, and the overall current account deposits from the government has fallen about 21%. Despite that, because of our strategies on current account, business account being open, 23% growth rate was there in the non-governmental account. Okay. I think this is a very good current account story for us.
Just to add, sir, So one is the current new customer acquisition and more balances in current account. Apart from this, retail current account customer or business current account customer, they are also giving us opportunity to sell other transaction banking products to them. They maybe you are prospective SME borrower also. So this is the value which is essentially hidden. You can say we have to yet to unlock, or in the process of unlocking. So this is giving us deposit on the one side, focusing on retailer business customer for current account, and also creating opportunity for other fee income plus maybe lending also in future.
Understood. Thank you. And so just lastly, one suggestion, your slide 15 is pretty useful. Can you also include quarterly data points? Maybe put a slide 16 with the same information but quarterly. It will be really useful for all analysts.
We will see. See, we didn't want to change the slides mid-year.
Yeah, so now that we are entering the fresh new year,
we'll try to improve.
It will be very useful.
Yes.
Thank you.
Sir, here Anand from MK. Sir, other OPEX seems to be on a higher side on a quarter-on-quarter basis. There is a lot of bunching up of other OPEX which happens in the fourth quarter. This happened last year as well. Is there a way, apart from any business acquisition cost, to spread out the OPEX one? And how do you see the cost-income ratio shaping up in FY27? Any efforts that you're taking to improve that? Because that's certainly on a higher side, given that we have a sizable corporate book, but still our cost-income ratio at about more than 50% is slightly on a higher side. What are the efforts that we're going to take on that front?
See, our effort is to keep cost-to-income ratio contained below 50. I think this is a guidance which we have given. And we would have had probably ended the year with 47%, but for the treasury income not supportive. Otherwise, the costs have been contained, both in terms of bunching happens because of the payment cycle which comes through. It is not intentional, but I think by design, much of the overheads are booked during the last quarter. So most of the expenses and income for Q4 has to be compared with Q4 only. Any other comparison will not work. So I don't think at this moment we are not thinking about, but we will definitely have a look whether any of the expenses can be spread over the 4 quarters so that we will not have that bunching issue.
Sure. On the forex open positions which were basically asked to unwind, so that impact we have largely taken in the fourth quarter itself, or that will happen in first quarter?
I did mention, I think we said that the Q4 MTM impact what you see is about 100 crores, and complete unwinding had happened on the 10th April, which resulted in a net loss of 57 crores.
Okay, that's very small. And you've guided for a credit growth of about 13 to 15% for FY27.
Yes.
Right, that's on a lower side versus what we had in this year. So 13 to 15% chances, probability of that we hitting the higher end of the guidance still is high, going to be strong.
I think as it stands, it looks good, except that how this West Asia conflict, how much it lingers, and apart if we do not factor in that at this moment, I think 13 to 15% seems to be a feasible option. See, at the same time, as I keep mentioning, the credit growth is a function of macros. We don't want to grow significantly higher than what macros can support. So if we have 6.5, 6.9% GDP growth with 4% inflation and nominal GDP of around 10.5 to 11%, we built around 3% over that, 3 to 4% max. If any of these numbers don't realize, then we don't want to grow as much.
And so what's a broader outlook on the MSME space? Because that's the one which has been impacted the most because of the West Asia conflict. Any stress pool that we have identified? Do I know that basically we're going to do a lot of ECLGS, but that again will be construed as that we are supporting that customer. So any stress pool that we have identified, any incremental provisions they're going to make, and that's why you're guiding for a 50 basis point credit cost in FY27?
No, 50 basis point credit cost is something what we've been guiding for the last 3 years. We continue to do that. It's nothing to do with the West Asian conflict. But even if some movement is there, we still are sticking to that guidance. Broad-based stress is not visible yet. There are clusters which are impacted definitely. For example, Morbi cluster, which is being talked about because gas is not being affordable by them, so they are not producing. Small and medium enterprises, they are affected. We are working with them, what kind of support they need. In fact, last month we have asked them to take annual maintenance. That period is also over now. They have to come back to production, but they have not come yet. But that is overall credit exposure to the whole cluster is very minimal. But they definitely need some support going forward. We'll have to see what support we can give. Other than that, hydrocarbons, obviously the oil companies are impacted, but there are very strong balance sheets. I think there are no credit related issues with them. They may have their own P&L issues, but it will not translate to credit issue.
Thanks a lot.
Let me just add a couple of points, just around the way we have been mitigating the risk in the MSME portfolio. We have launched BRE, I think we announced in several quarters back as well. This is giving good results. In fact, when we look at the delinquencies in a BRE versus non-BRE portfolio, BRE portfolio, the delinquencies are lower. That means underwriting models are much more robust. Second data point is like in terms of CGTMSE eligible loans, like which can be covered under CGTMSE. In the absence of that, we used to take partly it is to be collateralized. We have shifted from predominantly CGTMSE, so coverage is almost 58% of the universe which is eligible for CGTMSE. So obviously our mitigation is much higher and recourse to the CGTMSE is much higher. I think these are helping us to get a better handle on the quality of the portfolio.
Hi sir. Sir, Param here from Investec. Sir, question on your term deposit repricing. Term deposit repricing lower. Is it largely done or is there any...
Some residual tail end, that's all, but mostly done.
Okay. Sir, secondly on your salary costs in this quarter, it is generally Q3 to Q4 we see an uptick, there is the PLI related payout, but this time it's not there. Is there some...
there is I think classification change because the PLI which is to be given on the basis of the government PLI, it is still being debated. So we have not booked in the staff expenses what you see in our presentation. It is in other provisions. So if you add, I think it's broadly in the similar way.
So it's accounted for.
Accounted.
Okay. And sir, lastly, you will be saving on DICGC premium next year, right? So
don't ask me the number. I will
number or what you paid this year. That we can calculate the rest.
Sorry, no. As per the regulation, we are not able to. We are not supposed to disclose that. We will get benefited definitely, but this is not a disclosable item.
Okay, fair enough. Thank you so much, sir.
Sir, congratulations to Team SBI for multiple milestones.
Thank you.
Global transformation is a necessity for India led by war. Maybe business mixes are changing. I personally sense there is going to be a big capex boom in India led by energy. So we need renewable, we need nuclear. Data center needs a lot of energy. The Middle East attacks on Amazon may divert a lot of data centers to India. The transmission line expansion needs big growth. Any kind of indication or lead time which you are already sensing, because these ticket sizes will not touch base with a bank which is not of a size, and they will have to participate along with SBI to disburse the money. And SBI caps will have a big role because I see a lot of reports generated by them too, be it hydrogen, renewable and multiple sectors.
So I'll answer that and I'll also ask Ashwini to respond on that. Transmission, yes, I think is going to be one of the most important infrastructure which is going to be developed. Some of the projects are fairly large, as you mentioned. We have been having discussion with them. What kind of structures they will come out is not very clear yet, whether there will be an SPV or it will be done by their own companies. But there is a good opportunity coming up there. Apart from transmission, we also see a lot of emerging sector. I think last time also I mentioned we have started an initiative called Chakra. This is to support all sunrise sectors, whether it is green hydrogen or whether it is data centers, whether it is new renewable energy models which are emerging. So or even small modular reactors which government has been talking about, semiconductors. These are all the activities and sectors probably which have greater potential for investment. But they need a separate kind of structure. It is not a pure vanilla loan which they require. They may require a mezzanine funding, they may require equity funding. So we want to handle that kind of composite structures through our chakra. As far as transmission, Ashwini, you want to add something?
So, so 2-3 things. For transmission, of course, what Sarah said, transmission, a lot of potential. But I would also point out to battery energy storage systems. We got a large number of proposals which we are processing. We also have the data center is another activity where we have got a large number of cases we are looking at. Some we have already done. And then there are others like pump storage hydro, which is something which is starting to come to us. These are only 1 or 2 are live currently, but now a large number of people are coming because the latest tenders are all for round the clock power. It's not plain vanilla solar or hydro, etc. So with that combination, either BESS or pump storage hydro, combination along with solar wind is the new flavor. So we are seeing a lot of activity, and transmission clearly is one thing which is the need of the hour, because without adequate transmission, the curtailment in solar is quite high. So I think we are supporting all of that as it goes forward. And lastly, smart metering. We have done quite a bit already, but still there are a lot of enough opportunities there.
So when you highlighted a data center, are we funding GPUs or we'll only do infrastructure?
Both.
Yeah, both. So we look at the...
It comes as a package.
Yeah. Package. We look at the clients which are there. Because the way it is being presented here is more like a developer story. Because the developer creates the shell and ultimately the fit out is done by the ultimate user. And we are focusing largely on the hyperscaler model, because that's where the demand is assured and there is no, the client quality is assured. So we've got quite a few of them, and Mumbai especially has a lot of data centers coming up. We see a lot of potential in this area.
So this means that hyperscaler means your LRD business ticket size maybe 15-20 years kind of tickets. Yes. And competitive. How is that visibility, sir?
So as far as infra, the greenfield project is concerned, our ability to price is better.
So my last question, SBI has YONO 2, multiple retail salary accounts. Where touch points to customer are concerned on wallet share, how many products are we currently doing and what will we target?
You have any PPC number? But the last number I know is about 4.5, 2.5 to 3. Around 3 product per country, yeah. Financial products. So
but I think huge.
3 is okay, but our idea is to go take it to 5. And there are customers who tell me that they take about 8 to 10 products, different products from SBI. So that means that there's a potential to go to 8 to 10. But we would be okay if we reach a PPC of 5. So and the auto loans, what you have asked, essentially is a hook product. You can't make money on the auto loan itself, the dealer commissions and other things. But it brings many other product engagements.
But to reach 5, I suppose we'll need a lot of transformation where human resources concerned, specifically on retail.
True.
Where branches are concerned, connectivity. So everything can't be digital.
Yeah.
So how are we building up that capability?
So this is something what we mentioned, that how do we use our manpower at the branches when large number of transactions have moved to alternate channels. We are redeploying some of the workforce into sales and train our workforce in the branches for upselling. So this is something what is happening overall, and that is how you see that for a large bank, the diversified customer base, we have an average of 3 is a good number.
So this mutual fund and insurance business, are we tracking at each district level?
Yeah. And branch level also.
Branch level.
YONO also has deep integration with subsidiary production.
Sir, this is Mahesh from... we always face this charge of mis-selling, and although we are the lowest. So I think all of that is being attempted in the right suitability.
Good luck for the year, and thank you for answering all my questions.
Thank you, Chok sir.
So this is Mahesh from Kotak. So one question around the margins again. What is so different about this quarter in terms of the margins changing direction so sharply? Whereas if you look at the last 2 rate cuts which happened in March and June, the impact on the P&L was not that high. Whereas this time around you seem to be attributing the entire decline to that one particular variable.
No, I'm not attributing only for that. I said that the way the composition moved The
mix is not that high, right? So
sorry?
When you look at the
overall EBLR and T-bill link pricing has to be looked at. This is what I said. The corporate book has moved to a floating rate. Whatever growth has happened in the last quarter is also predominantly came from the T-bill, which gives us confidence that we can do the asset mix change going forward, and we're trying to move every T-bill linked loan to an MCLR based loan.
So just to clarify that one point, the T-bill increased last quarter, right, in terms of the price at which it was versus where it is today. That would have had a positive impact?
No. T-bill portfolio has increased.
But that portfolio would have had a natural upward repricing, right, during the quarter or in the last 6 months?
You have to compare with MCLR versus T-bill, not the T-bill versus T-bill. So the one which is MCLR linked earlier has moved to T-bill and bring down the yield.
T-bill there is a uptick.
There's a overall T-bill portfolio has had a good yield pickup. But if something is moving from MCLR to T-bill, then there's a dip in the earnings.
But this was a choice you took in advance.
It is not only choice.
Knowing.
I think the choice. See, it is also the composition of the users of the facilities. See, if you have seen, since you have asked that question, a little deep dive probably is required. A lot of large, well-rated corporates who were accessing the market has moved to banks. And most of their facilities were linked to T-bill. They were not utilizing at all. They were not using at all. They were using accessing the market, CP and all. That has moved to the bank, and this is the relationship value we have. While you all are looking at the NII part, we are looking at the overall value of the relationship with the corporate, which is not evident in the NIM.
True.
It is evident in our ROA. Where do I get the ROA? Where do I get the fee-based income, what you are seeing, and the other income? It is because of the relationship with the corporate. When they come back to us, I can't say that, I'll not give a committed T-bill rate, even if it means that there will be some softening of the yields on that. This is what I was trying to explain.
Perfect.
It's not purely on the 25 by ABLR, which anyway we have announced. What we have not factored in for a significant movement from the market to a bank.
So if I were to just simply draw the difference in the corporate sector and assume a large part of it was T-bill, I should be able to understand which portfolio took the T-bill portfolio.
Meaning?
If I were to just we are just trying to understand as to how long this impact will be in the...
No, these are all short-term impacts only. Predominant book has been in the short term. There could be some medium-term loans also which are T-bill priced, but in the current financial year itself, we would be able to move a large chunk into MCLR based.
Perfect.
There are two ways of handling this on the corporate side, particularly where we have very strong relationship. It is not only purely small working capital being drawn by them. Either you increase the spread over T-bill and say that, this is what the spread I'm looking for. If they are getting a better price, they move on. Or move them to MCLR. So these are the two strategies which we will be following this year.
Perfect. And one last question. When we do the calculated yield on advances, the decline has been fairly sharp. Now, one of the reasons could be that the book was grown towards the end of the quarter.
Yes.
If I were to just move into 1Q and 2Q, I know that you don't want to give a quarterly guidance. We're just trying to understand, does it dip first and then starts moving higher, or do you have visibility of how this traction will look like?
Mahesh, I don't want to hazard
I
a
understand
guess.
that.
I'm still sticking to my 3% annual NIM. But if you really ask me, I don't think there will be any further dip.
Okay.
If it satisfies you.
We wanted that answer, sir. Thank you.
Hi, sir.
I think we have to go on.
Hi, sir. This is Nitin Agarwal from Motilal.
Yeah.
So one question again around the corporate loan growth. If I look like last 2 quarters, we have reported almost 15% growth in the corporate loan book. While you talked about that, you are looking at things in totality in respect to ROA and ROE. But does this growth momentum, do you think this will continue in the next coming quarters? Because it will continue to have a bearing on the margins also, wherein we are expecting things to move up from here.
So the part movement also, as I mentioned, from market to bank. If the market improves, probably the reversal will happen. So that's the reason our corporate guidance is 12 to 13% is what we are looking at. And our 13 to 15% will be primarily driven by the RAM growth.
Yeah, due to paucity of time, we'll now take up a few
questions. You want to ask something?
Just one clarification on the ROA, wherein we talked about 1% plus ROA that we look to maintain.
Yes.
As we now start providing for ECL, you talked about a 3-4 year transition journey. Will that guidance stay unchanged over those 3-4 years, or you see some impact?
We are still saying that 1% through the cycles.
Okay, sure, sir. Thank you so much.
Sir, we have a few questions coming in through the online webcast now. These will be addressed by the chairman, sir, now.
I think there's one question why Q3 profit is more than Q4. I think it is the other way around. Why the Q4 is having less profit than Q3? It's mainly because of the MTM loss of 4,522 crores in Q4 as against loss of 143 crores only in Q3. This is a question from Venkateswar Rao. And question from Tamarish Sinha from Off Business. What is the guidance on net interest margin and NI for FY27? NI guidance we don't give, but NIM, as I said, our guidance for domestic NIM is to remain above 3%. And Vikas Bhatia, why was Q4 NIM so much lower? I think we have had enough discussion on this. If any further clarifications are required, we can have separately. Sunil Melwani, what are the steps bank is planning to take increase market share in CASA? This is what I mentioned in terms of focusing on the district level improvement on the market share, as well as a very strong campaign which we launched. I've seen good impact of that campaign is ABCD, all branches to contribute to deposits. I think this is also helping us in terms of mobilizing. And as I mentioned, savings bank, we've witnessed a good growth of almost double digit, 10% growth on a very large base of savings bank. Mrudul from Senora Asset Management, what was MTM loss provided for treasury losses? Was the same passed by NI. There's an MTM loss of 4,522 crores in Q4 as against 143 crores in Q3. The MTM is routed through other income, non-interest income. Rohan Mandora from Equiras, your cumulative domestic yield in advances for 12 months is down 11 basis points. So what is the domestic yield for Q4 and what explains the sharp decline? I think again this also we have explained at length what led to this yield on decline in yield. But essentially, as I mentioned, repo rate cut of 25 basis points and also shift in corporate credit composition. Siddharth Rajpurohit, our EBLR share is only 35%, so there should have been only some 7 basis points. I think we need to add both the EBLR book as well as the T-bill linked advances. So that is about 50. Currently we have E-bill and T-bill about 49%. Whether the bank has made any amount of provision based on ECL? No, not yet. Siddharth, again, share of AAA in corporate mix has risen by 400 basis points. Does it have an impact on yield? Guidance on the share of AAA going forward? As I mentioned, some of the best well-rated companies have moved from the market to bank, while it had dramatically altered the composition of AA and AAA. It had impact on the yields, as I mentioned earlier. Jeet from Ambit, please clarify off-balance sheet exposure like financial guarantee not required provisioning. Can we now assume that non-funded credit exposure disclosed in Basel III will require provision in ECL norms? Provisioning and non-funded credit exposure shall be computed as per RBI guidelines effective from 1/4/27. I think they also attract provision. So I think broadly we have answered the questions. We can go ahead now for closure.
I trust all the questions have been addressed. We will be happy to respond to other questions in offline mode. Let me end the evening with thanking Chairman Sir, MD Sir, the MD Sir, top management team, senior officials of the circle and various offices connected through webcast, analysts, investors, ladies and gentlemen. We thank you all for taking time out of your schedule and joining us for this event. To round off this evening, we request you all present here to join us for high tea which is arranged just outside this hall. Thank you so much.